Ladies and gentlemen, good day and welcome to the Bandhan Bank Limited Q3FY23 Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikash Mundra. Thank you, and over to you, sir.
Thank you, Inga. Good evening, everyone, and a warm welcome to all the participants. It's our pleasure to welcome you all to discuss Bandhan Bank's business and financial performance for the quarter ending December 2022. We will take this opportunity to update you on the recent developments in the industry as well as on Bandhan Bank during the quarter. To discuss all this in detail, I've got with us our founder, managing director and CEO, Mr. Chandrasekhar Ghosh, our Chief Financial Officer, Mr. Sunil Samdani, Head Retail Banking, Mr. Shantanu Sengupta, Head Housing Finance, Mr. Suresh Iyer, Head High Value Housing Finance, Mr. Subhash Samant, Head Commercial Banking, Mr. Suresh Chandran, Head Retail Lending, Mr. Hiraj Joshi, and myself, Vikas Mundra, Head of Investor Relations. Now I would like to request our founder, MD and CEO, Mr. Chandrasekhar Ghosh, to brief you all about our bank operation and financial performance along with developments for the quarter ending December 2022. Over to you, sir.
Good evening and namaskar to all of you. Firstly, on behalf of Bandhan, I extended to you and your loved ones best wishes for the new year 2023. I am pleased to state that the September to December quarter of this financial year has been on expected lines, rather it is slightly better than expectation. It has been yet another quarter of a decent business growth trajectory. The first half of the financial year was not as expected. We had to see more unexpected shocks in terms of NPAs, especially in the microcredit book, especially is restructure book. The bounce back in the economy is visible across businesses and among consumer sentiment. We have seen good festive buying by all sections of the society. As a result, credit growth of the bank has been encouraging. For the first time in the history of the bank, it has crossed 2 lakh crore in business. The overall advances recorded a 14% year-on-year growth in quarter 3, financial year 23. The significant growth for the bank has come from the retail segment, including housing and MSME. However, including the write-off, the advance growth will be 11% year-on-year. The housing finance book has registered a growth of about 28% year-on-year and 4% quarter-on-quarter. We have seen good demand for housing loans across the country, and we are planning to grow our housing book by more than 25% year-on-year. The retail loan book, other than the housing finance book consisting of personal loan, gold loan, two-wheeler loan, and auto loan, has grown by 133% year-on-year and 22% quarter-on-quarter. The commercial banking vertical, consisting mainly of NBFC, SCL is a small enterprise loan, and SME, with 87% growth in year-on-year and 12% growth in quarter-on-quarter. One important point I would like to highlight is that when we look at loan book growth, other than the EEB loan book, we have seen a growth of 48%, which is very encouraging for the bank. The growth in these segments is a welcome sign for the bank, as this is in line with the bank's portfolio diversification agenda and also in line with the trend of increase in business with the onset of the festive season. We are confident that quarter 4, like each year, will continue to further trigger business growth. As stated earlier, The second and third quarter of the current financial year coincides with the festive seasons and has seen stable momentum in economic growth, as many businesses return to normalcy given the significant increase in the confidence among the population of managing COVID. We are happy to see signs of strong demand for credit in most of the business in the third quarter, including the EEB. During the quarter in review, deposits have grown 21% year-on-year. We are looking to build a robust and granular deposit franchise. However, during the quarter, the bank has seen the movement of deposits from customers maintaining savings balance above 2 crores to bulk deposits. The same has been classified as a bulk term deposit. Also, due to the festive season, we have seen some impact of consumption on the deposit base. This is also in line with other banks as per the trends and progress reports released by the Reserve Bank of India. As a result, our CASA deposits have seen a degrowth of 3% year-on-year to rupees 37,212 crores, and the CASA ratio is still at a healthy 36.4%. The retail to total deposit ratio stands at 69%. We do not expect any further movement from savings account to the bulk deposits, so we will definitely see improvement in CASA deposits from quarter 4 onwards. A few numbers shows a strong momentum in our portfolio diversification agenda. The share of housing loan book to total loan book has increased from 24% to 27% year-on-year. The share of group loans to our total loan book has come down from 52% to 37%. Our share of commercial banking loans has grown up 22% to 33% in the total loan book year-on-year. Along with the business growth in advance and the deposits, we have also seen very encouraging collection efficiency trends during the quarter. We have seen good improvement in the overall collection efficiency. For the bank, overall collection efficiency excluding NPA stood at 98% in the month of December, up from 93% in the month of December of the preceding year and 97% in September month of this financial year. The collection efficiency for the month of December in the EEB, which is called the microcredit vertical, excluding NPA, improved 98% from 97% in December of the year, financial year 2022. Even while comparing to September month, we have seen the collection efficiency improving from 95% to 98% in microcredit. With the people's livelihoods coming back on track, we have observed an eagerness among our customers to standardize their accounts in order to continue to enjoy the benefit of formal credit by maintaining a healthy credit record. Our collection efficiency in Assam and West Bengal for EEB customers has improved significantly over the last quarter. It remains at 96% in Assam compared to the September 87%. And West Bengal, it is now a 98.4%, which was in a September 95%. An important point here is to note that our collection efficiency in West Bengal is higher than our national average. Bank has also received a sum of 917 crores as a part of CGFMU recovery from the government. We expect another up to rupees 1700 crores to come as a recovery in the first half of next financial year that is financial year 2024. This quarter, bank has also sold written off loans rupees 8,897 crores at an aggregate value of rupees 801 crore. Out of that, 387 crores has been issued as SR to the bank. The rest of rupees 414 crores has been reflected in the P&L of the bank. Our net profit for the quarter at rupees 291 crore against a net profit of rupees 859 crores in the last financial year, same quarter. Our net interest income has shown a minor dip of 2% year-on-year. It has come down rupees 2,081 crores in quarter 3 financial year 23 from 2,125 crores rupees in quarter 3 financial year 22. This is mainly because the higher reversal of interest income and also increase the cost of fund. Our net interest margin for the current quarter is 6.5% compared to the 7% last quarter. Even after the dip, we are still amongst the highest in the industry, but I would like to mention a few points here. First point is that we have a high interest rate by nearly 2.5% in the last few months on advance. This quarter, we have also set up a separated team of current account mobilization. Till now, it is working is very good with a branch network. We expected lower interest reversal from next quarter onwards. The impact of all these things will be seen as an improvement in NIM from the next quarter onwards. We'll also consider further rate hikes if required. Total credit cost for the quarter was at 6.4% compared to 3.7% in the previous year and 5.3% in the last quarter. This is largely due to the increase in provision coverage for the stress during the quarter. Our gross NPA stood at 7.2% versus 10.8% in the previous year, but our net NPA stood at the 1.9% versus the 3% in the previous year. During quarter 3, the gross and net NPA ratio has remained flat compared to the sequential basis. However, here we have to keep in mind that the majority of the slippages during the quarter are from the already declared stress pool. We are also used data science and analytics for the purpose of NPA management and recovery and also the business growth. It has already shown positive result for the bank. With the initial trends and reports from the growth, we are confident that quarter 4 will see good improvement in the performance of the bank. We have already seen our SMA book coming down by about a percentage point. We have also seen improvement in our DPD book across buckets, which gives us confidence that the worst is terms of slippage is over. Many of our customers have been paying regularly and are showing their intent to regularize their overdue account. But until the entire overdue amount is recorded, they cannot be categorized as a non-NPA customer. In the third quarter, number of full paying customers have increased from 88% to 92%. The amount wise, it is a 92% to 96%. If it is go to this, the number of non-paying customers have decreased from 6% to 5% quarter on quarter. But if I say that the amount wise, it is coming non-paying customer 2% to 1%. which have been shows to the bank on that the customer is coming to this regularize their account, and future credit growth and quality will be better. From the recovery perspective, we have seen that the total recovery and upgradation for this quarter is rupees 622 crores. We are engaging with our customers on a regular basis to encourage them to ensure timely payment and recovery wherever needed. We are confident that it is only a matter of time before these customers regularize their account fully, after which we expect to see a significant drop in the gross NPA in the next couple of quarters. The bank has also seen the total fresh slippage has come down 700 crores from the last quarter, which is this quarter has been slippage fresh in the 3,265 crores. In the last quarter, it was a 3,954 crores. The majority of the slippage is from the already disclosed stress pool of COVID. Within this, our fresh slippage in the EEB segment was 2,846 crore in the quarter, which was in the last quarter 3,624 crores, which is 800 crores is in down. We have made provision of 1,542 crores, including NPA and standard asset provisions in this quarter. We are also more than covered in terms of our provisions. The total provision of the bank stands at rupees 6,257 crores. We have seen 1% increase in our PCR at 75.4%, which has increased from the 74.4% in the last year. Bank has done a write-off of rupees 2,533 crores in this quarter. Coming to the outlook for the last quarter, as you all know, we are seeing economic activity picking up and business coming back to the normal across the country. Bandhan has always had an ear to the ground, given its the distribution reach, and we have observed that our customers' businesses have been gaining traction once again. We remain confident that this will have a positive impact on our business operations. We have started new streams such as a commercial vehicle lending, loans against property for business. You know, we have been also started the government business operations in the bank. Among others, this will add further revenue streams over the next few quarters. We also go live on our IT transformation project in the next financial year first half. We expect to grow our advances and deposits by 20 to 25% CAGR over financial year 25, with our focus remaining strong on the retail segment and diversification. With our continuous effort in diversification, investment in technology, people and processes, the Bandhan growth story remains strong and promising. We have added about 9.4 lakhs new customers in last quarter. It is also showing that how business is growing. I wish you, your family, and all the very best. Please take care, stay safe. Thank you to all of you.
Thank you, sir. Now I would like to request our CFO, Mr. Sunil Samdani, to give you more details on financial parameters during the quarter. Over to you, sir.
Thank you, Vikas. Good evening, everyone. First of all, let me take this opportunity to wish you all a very happy new year. While Mr. Ghosh has mentioned most of the highlights of the quarter, I just want to particularly focus on few aspects which I think is important for everyone to understand what went in this quarter. Let me start with the asset quality. particularly on the EEB side. This was the quarter where we have seen the slippages from the restructured pool happening, and as per our estimate and the guidance which we had given on the 1st of December, we are pleased to inform that we have done better than that across all counts, whether it is NPA, whether it is stress pool, and the provision coverage ratio around that. And this I am talking without considering the write-off effect. So on a like-to-like basis, we have been better by 2 to 3 billion across all the sides, whether it's NPA, stress pool, and the provision coverage. Secondly, I would want to highlight slide 5 of our presentation, where it is pleasing to see that our collection efficiency, excluding NPA customers, have gone back to the pre-COVID level. And this improvement is across pan-India, including our core geographies of West Bengal and Assam. So while West Bengal stands at 98% for the month of December, Assam has improved substantially from 87 to 96, and rest of India at 98. What is more important is the customer behavior and the paying profile. We now have a situation where 96% of our EEB customers pay full installments, which means 3% of them are partial paying installments and 1% is non-paying installments. So this gives a comfort that the flow going forward will be contained, because it's only these 4% of the customers within which 3 are part paying, the forward flows will be visible. On slide 6, there is another important messaging, which is the improvement on our delinquency buckets. It is heartening to see that across all buckets, we have seen an improvement, and even if I don't consider the benefit of write-off, we have seen a 3 billion reduction in the overdue pool. What this gives us an assurance is that the flow forward has stopped and there has been an improvement or rather rollback from the delinquent customer base. So this gives us the confidence that going forward, we should see a much lower slippages in line with our guidance. Lastly, on slide 7, here we typically guide the reader on the stress pool that we have on our EEB portfolio, which got built on account of pandemic, and how are we addressing them. It is heartening again to see that at the end of September 22, we had a stress pool of 95 billion. Against that, we had a provision of 53 and a CGFMU expected recovery of 25, which effectively means 82% of our stress pool was covered and the rest we have to work on the recovery side. Now this ratio of 82% has improved to 91% as on December 22. 88% rather. Of the total stress book of 76 billion, we now have a provision which is recorded. So what is important here is, while my stress book has come down from 95 to 76 billion, my provision is consistent at from 53 billion to 50 billion, which means we have not utilized our provisions fully. We've continuously created buffers and strengthened. And given our experience and of the CGFMU recovery and the slippages that we have seen from the portfolio which is covered under CGFMU, we now expect another 17 billion to come in the first half of the next financial year. So with 50 billion of provisioning and 17 billion of the CGFMU expected recovery, we've almost covered 88% of the total stress pool. As always, we are not considering the Assam relief scheme, which is an added positive as and when it comes. What is also important here to mention is on the NIM side, if I have to talk, right? Optically, you may see that our NIMs have come down quarter on quarter from 7% to 6.5%. But that has largely to do with the large slippages into NPA that we've seen in the month of October and November. If we look at December month, the NIMs have already improved to 7.3%, And as the repricing of the interest rate increase that we have taken over the last 3 months factors in or kicks in, we should see a further improvement here. On the slippages side, as envisaged, we've seen a lower slippages quarter on quarter. The numbers have already been discussed by Mr. Ghosh, so I will not repeat them. And that gives us the confidence, given the lower DPD pool and the improvement in collection efficiency and the paying profile of the customers, we expect slippages in the month of October to be materially lower, in line with our expectations, and hopefully on a steady state what we have guided, it should come in line with that. I know you will still have few questions. Happy to take them. Thank you
very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, good evening. So if you could give us a color on what the steady state SMA pool would be, like a completely normalized SMA pool on the EEV side. That's my first question, and I have a few more.
So there again, steady state is all depend on the environment. But if you talk about pre-COVID levels, that's where we used to have a gross NPA of about 1.5% and another delinquent pool, the stress pool that we call it, of about 3%, right? In the new scheme of things, we say that, the steady state credit cost, or rather the collection efficiency for the microfinance or the EV business should be taken as 98 instead of 99. So you can add another percentage points to a steady state that we used to have historically.
Okay, makes sense. And my other question is on the new ECL norms. How would they impact you? Are you filing any mock runs with the RBI already? And any sense you can give on if the, say, circular were to be effective soon? I know it will not be. What would be the impact between IND-GAAP and IND-AS?
So as far as banks goes, at least Indian banks have been, submitting the pro forma IND-AS financials, which includes the ECL calculation as well, to RBI on a quarterly basis for the last 2 years. So we keep filing on a quarterly basis the IND-AS financials, and if we take that as a reference, there is no material difference between the provisions that we carry and the provisions that we are required to make under the ECL provisioning norms. This, of course, is based on the IND-AS definition of ECL. So if there is a tweak to that definition which RBI brings in their final recommendation, that needs to be factored. But if you go by the standard IND-AS way of calculating ECL, there is no difference.
Okay, got it. And so would that be lifetime ECL or just like say 2-3 year loss model? Any idea?
So here, as far as IND-AS goes, we take last 7 years, that's our lifetime span and the experience, and basis that we file it with the RBI. But more importantly, it's a factor of your probability of the default and the provisions that you carry in your book. Since we've always been carrying adequate provisions in our book, right, even if I have to take a 7-year or a 3-year precedent or the average, I don't think that will have a material impact on, or rather any impact on our ECL or provisioning requirement.
Got it. And just one last question, your outlook on deposit growth for FY24, given that there is a lot of competitive intensities increasing in deposit taking, so your outlook on deposit growth and margins for next year.
I'll request Mr. Shantanu Sengupta to take this question. Shantanu.
Yeah, sure. Thank you, Cyril. Good evening and thank you Maruk for the question and wishing all of you a very happy new year. The question on deposit outlook is we are quite optimistic given despite the fact that we see intensity in terms of competition because of few reasons. One, I think the focus for the bank has been to grow our organic book, and as we move forward, the granular book is growing, steadily. So that's one comfort that we have. We've also invested a lot of effort in terms of, creating some new initiatives for the bank. We are expanding our branch network. We are investing in digital. So we are seeing opportunities that carve out as triggers of growth going forward. So to answer your question, our outlook for deposit growth remains positive.
And just to add on the margin side, if today till December quarter, our rates on TDs were in line with the rates offered by other banks, and we believe with a 25 basis point premium, it should not be a problem to garner deposits for our growth that we are looking and going forward.
Okay, thanks a lot. Thank you.
Thank you.
Thank you. We'll take our next question from the line of Krishnan ASV from HDFC Securities. Please go ahead.
Happy New Year. Yeah.
Go ahead, sir.
Yeah, hi. Wish you all a very happy New Year. So thanks for taking my question. I just wanted to understand you made an announcement around the fact that people who have been in default don't get money back until they are able to completely pay back, and then there is a certain sunset clause, etc. I just wanted to understand how or is it possible for you to share any disclosures around the fact that money is not going back to these same borrowers at all, just to create more confidence among stakeholders? Is there anything that the bank can do to demonstrate that, look, this money is not being given back to the same? It's not that this money is coming back because we have got new money to get the old money back.
So Krishnan, firstly, let me clarify that we don't give a new loan unless the earlier loan is repaid, right? So it's never a case that we offer a loan with an earlier loan outstanding or the customer is still delinquent, right? So that's point number one. Point number two, our change in credit norms was that after the customer repays the earlier loan, if the customer has flown into NPA, despite repaying the earlier loan, we would still wait for 90 days and only then give them a fresh loan. This was because as we mentioned in the previous call, we don't want customers to be opportunist, right? Because they want a new loan, they come and repay us, but during the tenure, they were not disciplined and moved to NPA. So it's a messaging that we want to give to our customers that if you are not regular throughout the loan, you are not eligible for a new loan. So the change here is despite customer paying, we don't extend a new loan.
Right. Right. Understood. Now, I mean, while you made this fairly, and is there anything that the bank can do to demonstrate this in any way at all? Just to.
So let me explain that, right? So we made this policy starting, 1st of October or 1st of August, September sometime, right? That we should not extend loan. During the quarter, we saw some 400-500 customers receiving the loan after paying the earlier loan, and we proactively took provision against those and asked our team that not to take any, not to extend any further loan. So it has been a very strict policy that we are following because we want the messaging on the ground to be very clear. It was a small amount of 20 lakh rupees, but still the messaging has to be very strong that once there is a policy, we can't deviate from that policy.
Understood. My second query is around just the pivot that you are now making to go from a relatively subprime customer base more towards prime across most of your customer segments, across most of your businesses as well. Purely in terms of the acceptance of, Bandhan, I know there has been some chatter around this. So just wanted your thoughts around acceptance of Bandhan as a brand in some of those businesses. How have you found the early evidence thus far?
No, so Krishnan, if you had asked me this question on the deposits, I would have still felt there is, there's something that we discuss here. In a lending, clearly it doesn't matter so much that who is a lender as long as the customer gets the right money at the right rate. Right, and in our case, even on the deposit side, our momentum is strong, and we've got that branding and the image to get that customer trust. So I don't think that's an issue that we face and that we discuss. Our endeavor is to continuously improve our customer service and customer experience. That is what we focus on, and that helps us building trust and confidence.
Okay, got it. Thanks. I'll come back in a few. Thanks.
Thank you. We'll take our next question from the line of Adarsh from CLSA. Please go ahead.
Hi, Puneet team. Question is on the slippages, right? If you could
sorry to interrupt, Adarsh. If you're in a speaker phone or a hands-free, switch to handset and speak.
Yeah, I hope this is better. So on the slippages, Sunil, just wanted to understand what was the slippages in the quarter, and if you could highlight what was the slippages if you remove the spillovers from any kind of stress which was there, right? So the slippage from the standard book in the MFI portfolio in this quarter.
So for the MFI book, my gross slippages for the quarter was 2,846 crores. There was a recovery and upgrade of 376 crores. Right? This recovery and upgrade I'm talking is from the NPA, not from the written off account. That is additional. So just from the NPA is 376, and from the written off portfolio, which is a non-ARC portfolio, it is 140 crores. So that's on the numbers of gross and net slippages. Within this 2,846 crores of slippages, 90% of them is from the stress pool, which is already identified.
So you're saying that only 300 crores was the slippages from the non-stress pool?
Less than 300.
Got it. And just the second element, right? You all mentioned the margins of 7.3, right? Which is adjusted for all the interest reversals. Just want to understand, if you take a 2-year view, there is a drastic change in business mix that will happen. You all have taken a rate hike that will come in. What's the fair margin that you would expect as you have some of these yields kick in, but also at the same time the share of MFI go down?
So there again, firstly let me explain how this shift would look like. Right? When we say the share of MFI goes down, it's the group loan which goes down. Right? The SBAL customers, which are at the same yield, gets reclassified as commercial loan. Right? Between SBAL and MFI, we would still be around 55%, right? Which is at the similar rate of interest. Right? So the impact of change in mix for the next 1 to 1.5 years will not be more than 50 basis points. Now, from which rate 50 basis point is the question, right, we expect our steady state NIMs to inch up from 7.3 that we clocked in the month of December. And we expect this to go up to 7.75. And from there, we should see the impact of change in mix to come in over the next 2 years.
Got it. And so the yield change that you had to 50 bip was in when was this implemented? Just trying to get a timing of when does the margins improve on the MFI book.
So the 250 basis point increase that we took in EEB, 200 basis point came in November first week, and 50 basis point was sometime in September, end October.
So you moved from 19 to 21 and a half, is it?
21.95.
Got it. And the previous whole thing that Bandhan, it's a bank, people look for, we've offered them a lower cost of fund benefit. When you became a bank, you lowered your rates to closer to 19%. What happened to that? I mean, I'm just trying to understand as to would that not be the expectation that would prevail?
No, that continues, right? The differential between the Bandhan rate of interest against, if you compare it with the industry, it is still 250 to 300 basis point lower. So that continues. It's an interest rate environment, the credit cycle environment, which has to be considered.
Perfect. All the best, Sunil and team. Thanks.
Thank you. Thank you.
Thank you. Our next question is from the line of Saurabh from JP Morgan. Please go ahead.
The question is more near term. So in the analyst meet should direct, around 3,400 crores of.
Sorry to interrupt, Saurabh. We can't hear you clearly. Please switch it to handset and speak.
Is this better now?
Yes, thank you.
Yeah. So at the analyst meet, you had guided to around 3,400 crores of credit cost. So now, plus the SR recovery, so would you fall into that 350, 400 crore number now? This is the guidance.
So we were, we had earlier guided that in H2 we will look at 1,500 crores of credit cost, between, which will be divided as 1,000 crores in Q3 and 500 in Q4 broadly, right? And if you look at our numbers now, it is still in those lines, right? While it looks 1,500 is because we got that 414 crores of ARC sale upfront, which we took as provision. Right, and increased our coverage. What we discussed earlier, that my stress pool coverage has gone up from 82 to 88%. Right, so that's where this 414 crores was utilized, and that's why this looks higher. So it's otherwise, if you remove for this, it's in line with our guidance that we had given.
So 4Q should still be around that 500 crore mark, actually, position.
So yes, plus or minus 100 crores.
Okay, got it. The second side is essentially just for this, you've given some disclosures on your OPEX. So there is a CGSMU provision you've done for 9 months at about 90 odd crores. So will it be fair that this will run off next year?
While it will not entirely run off, it will come down materially because my outstanding book has reduced materially. Right, and so next quarter we expect this number, quarterly number to be, because since I will be claiming in the next financial year, I still need to pay the premium in the next financial year. That's point number one. But that quantum of premium would come down substantially from 90 crores a quarter to about 20 crores a quarter.
Okay, got you. And this last question, sir, this SMA 0, which you don't include in your stress book, it's about 3.4%. Will it be fair that since your collection efficiency is 98, this number will not realistically go down below 2.5%?
Sorry, Saurabh, can you repeat the question and can you please be a little closer to your microphone?
So just on this SMA 0, this 3.4% you have, which is not considered. Will it be fair that this number does not go?
Saurabh, your voice is breaking. Sorry to interrupt.
Okay, I'll take this offline. Thank you.
Okay. Thank you. We'll move to our next question. That's from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, a couple of questions. First is around, we have seen a good progress in the month of December. Margins have also been improved in this month. And so, can we say that the probability of default now from the SMA number that we have reported will be much better than what we have seen in the prior quarters now?
You mean the slippages?
Yeah, the slippage rate from the outstanding SMA pool now, is it likely to decline pretty sharply now that the December was a pretty strong month for us?
Yeah, so slippages, as we said, that since my SMA pool has come down and most of my restructured book has already flown, almost 95%. So slippages has to come down and will come down. And it will come down materially. It's not what we saw between Q2 and Q3. So there will be a marked improvement there.
Right.
And that is evident, if you look at for the month December, the way NIMs have moved.
Right. That's what I was looking at, yeah. And secondly, on the SA side, wherein we have reported a decline in CASA, and that probably we indicated that is largely because the customers migrating to term, wherein the ticket size is more than 2 CR, and we also had to classify them as bulk. So what is the total quantum of SA above 2 CR? Because that will tell us as to will this number go down further or not.
So, if you are a rate-sensitive customer, you will not wait for 6 months, right? So, while I'll take your question, the point I want to make here is a customer who's a rate-sensitive and who was earlier not getting a differential between a term deposit rate and a CASA rate, because I was offering 6% in savings and 6.25 in term deposit, they chose to keep it in savings. Now there is a difference between 6% to 7.5, 7.75, right? So they have moved. So that's the movement we saw. To your question on what is the proportion of SA above 2 crores in our book, it should be around 10%, a little less than 10%.
Okay, so you think that vulnerability may remain on that? On that 10%, we may see more vulnerability as probably the rate?
No, not really. As I said, if these customers had to move, they would have moved by now. And since these are high ticket customers, they have a relationship officer and they are continuously in touch. So we have a fair sense of their behavior.
And about 90% of our customers continue to be in the individual segment.
Yes.
Where the deposit they keep in the savings bank is below 2 crores.
Yeah.
Right. And lastly, any discussion going on in respect to recoveries from some relief scheme? And what can be the ballpark number that we can get from this?
So as always, this is a crystal ball which I don't want to give, right? Because it is not something which is my right. It's a scheme of a government. While we have started distributing the checks to the delinquent customers, it is still not material enough to talk.
Okay, sir. Thanks so much.
Thank you.
Thank you. We'll take a next question from the line of Rahul from Goldman Sachs. Please go ahead.
Yeah, thanks. Hi, Sunil. Hi, Mr. Ghosh. Am I audible?
Audible.
Thanks. Sunil, just, on your slide 7, just wanted to understand these numbers a bit better. So 76 billion is the EEB stress pool. You're expecting CGFMU recovery in the first half of 17 billion. So that comes down to roughly about 60 odd billion. So that against provision plus estimated recovery of 60 would be almost like negligible pool, right? So there is no incremental provisioning that is needed, but for the new stress zone formation that might happen from the portfolio. Is that a fair understanding?
Yes, but there could be timing difference, right? Because let's say this money comes in September, right? But you are assuming that they are like to like in terms of timing. So other than that, yes, if you talk about a 6-month period, your understanding is absolutely right. 9 months period from today.
So in that context, the fourth quarter provisioning of 5 billion, would that also be needed? Apart from, of course, the vintage movement?
It will be. If you see, even in this quarter, while my stress pool has come down from 95 to 76, my provisioning has not come down, right? From the 53 billion, I'm still continuing to hold 50 billion. So if I have an opportunity, why not? In line with my guided credit cost guidance, I would want to strengthen this.
Okay, but there was an element of write-off also, right? I mean, so that's
Yes.
fine.
So that also took some
Yeah.
time.
Great, thanks. Just on the active MFI customer, so you give total and active, whereas the ratio has kind of reduced quite a bit of active to total. I think by about 10 percentage points in the last year, and maybe even more if you compare the last couple of years. So this reduction is, I presume, mainly because of write-offs that we may have done of these customers, and therefore the improvement in this number. How should we think about?
No, so you are right. A part of it is because of write-off. And once this write-off stops, which we believe is the time, unless we optically change the gross NPA numbers, right? So this number should start going back to that original ratio.
So the growth in MFI book will be more driven by, therefore, ticket size, is it?
No, not really. Not really. It's both, right? My new customer acquisition doesn't stop.
Yeah, but those customers would be like at what ticket size? 30,000 rupees, right?
So MFI is up to 50,000 rupees, and then there is SBA.
Understood. And then of the total number of customers, active one that we have, how many are in SBAL, the small business loans?
17 lakhs.
17 lakhs. Got it. Just, one last question on the disbursals, in EEB pool. It's down quite a bit, I guess understandably so. I'm looking at slide number 12. It's down from 200 odd billion to 152 billion. So in the fourth quarter, as Mr. Ghosh also articulated, should we expect a big recovery in this number from 152 to maybe north of 200 to 50 billion of disbursals?
So it's a very difficult thing to quantify that today. But clearly, historically, Q4 is the best quarter for us. So it should be higher, and it continues to be higher. One should also factor the tightening that we have, the change in policy that we have done, which would slightly impact on the disbursement side if you compare it Q4 versus Q4. I'm not comparing Q3 versus Q4. So Q4 will clearly be a best quarter in terms of disbursement. That much I can assure you.
Okay, and just one last question I want to squeeze in is the discussion with RBI on PSL. Any updates there?
So no updates. So hopefully we'll restart this in next financial year.
Understood. Great. Thank you, Sunil, and wish you good luck for the subsequent quarters.
Thank you.
Thank you. Our next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Hi. So congratulations on improvement on the stress pool. Firstly, in terms of the write-off, so I think that's still continuing. So last quarter we saw some sale to ARCs of the return of portfolio. So would we be evaluating further sale to ARC or with the same ARC wherein we have contracted? How would that be over next couple of quarters, and any recovery expectation from this? Because last time it was 10%. Now, how would that behave? Yeah.
So let me take your second point first, right? When we did the deal at 10%, that is not the expectation that we have on the recovery, right? Because that valuation depends on the structure of deal. In our structure, we have assured IRR to the ARC, and beyond that, any further recovery comes to us, right? So we don't want to, part away with the recovery of all our customers in the same ratio. So that is how we valued that transaction, because we believe that our customers are loyal, and as things improve on the ground, there is a good scope of recovery, and that's how we valued that deal, right? So So effectively, the point I'm trying to make is that's not our fair estimate that we would recover. We expect a better recovery than that. That's the point. And to your first question, whether this is something that we will actively look at, well, it's a commercial decision. If we get a good value, why not? If we feel that if I have to do the net present value, I'm better off, I will look at it, or else, because ultimately it's me who is doing the collection, right? So nothing changes there. So it all boils down to a commercial decisioning, and if it works in our favor, we'll do it.
Okay. So that can still be evaluated, yeah. And secondly, in terms of this housing finance disbursements, okay, so how should we look at the quarterly run rate? Maybe there was some moderation out there in this particular quarter. Any reasons for that? And eventually, over the next 4 to 8 odd quarters, what kind of a disbursement traction can we look at it, the kind of franchise which we are trying to build?
Suresh, you want to take that question?
Yes, sure. Thank you, Sunil, and good evening, everyone. So in the housing, there has been, the main factor why there has been a slight slowdown or whatever, or stagnation, is because this quarter we've experienced a very high increase in the rate of interest for the customer. So the EMI and eligibility is actually coming down. That's the main reason why we've had it. But with the demand still being strong, and two, with the rates almost stabilizing and likely to come down, in fact, it should again pick up. So, and again, Q4 is always the best quarter. So we definitely expect that things will pick up, and this was probably just because of the rate revision that it is there. Otherwise, it will definitely pick up.
Okay, so on a quarterly run rate basis, we can get towards the 2,500 odd quarter, 500 odd crores.
You're talking about the disbursement or the book growth?
Disbursement.
Disbursement, definitely we should be touching at least crossing 2,000 crores in a quarter, definitely. In fact, it could be normally, as I said, the Q4 is the best quarter, so it is likely to be better than that. But yeah, 2,000 definitely should be possible and will very soon happen.
Sure. And lastly, in terms of the deposits, so given that the retail proportion is coming off, and there has been some reliance on the wholesale deposits as well, what would be our stance with respect to the increase in the rates now? So deposits, I think we are still at 25, 30 odd bits the premium to the other leading banks. Would we want to have maybe a higher gap and try to mobilize more of a retail deposits?
Yeah, so it's a combination of both. In fact, we are watching the market closely. We do believe that interest rate cycle is coming to a peak, so we are watching that closely. We do believe that there could be one more rate hike as we look forward. But yeah, it's part of the strategy in terms of how we sort of garner the deposits.
Okay, but any increase can be expected? Maybe lending, we have seen that kind of a pass on almost like 250 odd basis points. On deposits, if we have to look at it, say from March till over here, it's been almost like, say, 150 odd basis points kind of an increase for us from 5.75 to almost 7.25.
Subject to what is happening in the market and RBI rate increase, on that basis, it will become on that. As of today, we are not feeling on that. But if one trans will be again increased, the repo rate increase, so maybe that will be like to impact on that. I hope that this is not coming much more on that as per previous record.
No, the question only was maybe when we look at the bulk deposit proportion, that's significantly up, okay, even on a year-on-year basis, and every quarter we are seeing the huge build-up. Like last time it was 25, now we have seen like almost 31,000 crores. So not able to understand, maybe should we continue with that kind of a bulk deposit proportion in the overall pool, or there would be a real retail deposit accretion strategy as well, yeah.
No, so Kunal, sorry, Shantanu, go ahead. Yeah, please. So Kunal, I think, as I mentioned earlier, see, the whole deposit growth strategy is a mix of, growing your organic growth, growing to some specific segments, looking at interest rate, looking at the strategy, looking at what the market is, is currently positioned at. So I think the answer to your question is yes, we will look at it. But the point is that it's not something that we want to commit right now. We are not close to raising rates. I mean, you've seen that. But the point is that we are looking to grow the non-individual, the individual book more than the non-individual, as we sort of try and balance out the steadiness of our organic growth. So as of now, that's the outlook that we have, and we are seeing some good trends coming in, and hopefully as we go down the coming quarters, the reliance on large bulk deposits will obviously come down as we grow the organic book. So I hope that addresses your question.
Sure. Okay. Yeah. Thanks and all the best. Yeah.
Thank you.
Thank you. Our next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hey, hi, Sunil. Just a few questions. One is, how have you accounted for both the security receipts income as well as the CGFMU balances?
So CGFMU of 917 crores, we have adjusted 785 crores from the provisioning. Right? The balance still continues to stand as liability because that's the recovery we have done on the from the cutoff date, right? When we filed, which is October end till December. So that
785 crores is the income which has gone into the NPL line, is it? Right, as a reduction.
My NPA provision has come down to that extent.
Okay.
785.
And you also added 440 crores against it from the receipt of SRs.
Correct. So let me tell you the maths, Mahesh. If you see my flows to NPA for the quarter is 2,644 crores. The increase in NPA for the quarter pre-write-off. Right? How have we addressed these 2,644? It is 785 crores of the CGFMU money, the 414 crores of ARC sale money, and the rest is the provision that I have booked, which is about 14-15 crores. The requirement was less, but we took more provision to improve the coverage ratio. So that's why you see, despite the stress pool coming down from 95 to 76, my provision still continues to be similar level of September. And despite the write-offs of 2,500 odd crores.
And on the other hand, what will be the movement of this 917 crores in your gross NPL line?
Nothing. So it only reduces my provisioning. That's it. It doesn't change my gross income.
So these are not in the gross NPL line itself in the first place. It was written off earlier, is it? No, there will be loans against it, right? Like the 1,300 crores of loans which was sitting against which you got 920 crores.
Correct. So these are there, which is part of my NPA book. Against which I have received the claim, and as per the CGFMU circular, this can be used to adjust the provisions required.
That's right, Sunil, but how would you adjust it on the outstanding loan book?
So for that I have taken the prudential write-off.
You took a write-off, okay.
Yeah.
Okay, perfect. So I would assume that you also made a similar 414 crores as, or in other words, can you give us a breakup of your other income?
Okay, I shall, but let me explain for the benefit of others also on the 414 crores. So 801 crore is what we received from ARC, right, as the valuation of that pool that we sold to them. Of that 801 crore, 387 crores worth of SR was subscribed by Bandhan, and 414 crores of SR were subscribed by ARC and another investor. Right. So to the extent of the SR that we have subscribed, which is 387 crores, we have taken a provision against that 387 crores. So the book value of those SR in my books is zero. Right. While there is an SR on the asset side, there is a provision on the liability side.
The balance 414 crores which I received from a third party, which is ARC and investor, that I have taken it as other income, non-interest income, and which was utilized for creating provisions. So that's how the accounting of the 801 crore was done. As far as the breakup of the non-interest income goes of 1,033 crores, if I have to list down the top five or four elements there, clearly 414 is the biggest, which is the ARC sale income, followed by processing fees of 212 crores, then the bad debts recovery of 140 crores. Typically we used to recover about 70-80 crores every quarter. It has gone up to 140 crores because as customer realizes that we are not gonna pay or lend to them unless that discipline is coming back. So that is 140 crores. And the other large piece is the third party distribution of insurance and mutual fund, which is 90 crores.
Thank you, Sunil, for this.
Thank you.
Thank you. Our next question is from the line of Manish Shukla from Axis Capital. Please go ahead.
Yeah, good evening and thank you for the opportunity. So Sunil, you said that as of December, roughly about 10% of your SAR customers would have been more than 2 crore. What would this number have been in March 22?
Sorry, Manish, I could not hear your question. Could you please?
The share of SAR customers with more than 2 crore deposits, you said that's about 10% today. What number would this have been in March 22? The proportion?
That would be much larger because we've seen the movement from saving bank to term deposit this quarter. So earlier in March 22, there was no big difference between my SAR rate and the term deposit rate. So they preferred to keep it in the SAR. Unfortunately, I don't have that March 22 number ready available here.
Sure.
But clearly this would have been much larger.
Mr. Shukla, I'm sorry, but we are not able to hear you clearly. Please switch it to handset mode and speak.
Is better? Yeah.
Your voice keeps breaking up, so I think you're on your earpods or something. Just switch it to handset.
Please go ahead.
Give me one. I'm talking about the slippages numbers for the quarter. You said 2,2846 crores of slippage, of which roughly 90% was from the existing stress pool. That makes it 2,500 crores. But the QOQ decline in stress pool is about 1,900 crores. So that essentially means there is an additional 660 odd crores of addition to the stress pool. Is the math right or am I missing something?
No. So stress pool I have already given, right, in my presentation.
Yeah.
And if you need to adjust it pre-write-off, you can do that because the write-off numbers are already available, 24 billion, which is also mentioned below that. Right?
Okay, fair enough.
If you look at the slide 7, you will see the stress pool and how it has come down and what has contributed how much.
Okay, fair enough. I'll maybe take it separately. Lastly, at the bank level, can you please provide the movement of NPA again, slippages, recovery and write-off for the entire bank?
Yeah, so the slippages for the entire bank was 3,265 crores gross, recoveries of 622 crores, and the net addition of 2,644 crores.
And the total write-off at the bank level?
2,533 crores.
Okay. Thank you. Those are my questions.
Thank you.
Thank you. Our next question is from the line of Jai Mundra from BNK Securities. Please go ahead. Mr. Mundra, could you please unmute your line and go ahead with your question? There seems to be no response from this line. We'll take our next question from the line of Param Subramanian from Macquarie. Please go ahead.
Hi, thanks for taking my question. My question was on the steady state or the near-term margin outlook that you guided, Sunil, of 7.75%. So little color on that. So if we just do a rough math, 250 basis point hike if we take on the overall microfinance book, shouldn't it be materially higher than that? And considering also the housing book will reprice along with the increase in funding costs. So, just some, outlook on the near-term margins. Yeah.
No, so Param, what we are discussing is the next 2 quarters. How do we define near term? Right. We are saying that as of December end, we are at 7.3, and this will keep improving as the repricing impact and the slippages impact lower slippages impact starts get factoring in. So by next 2 quarters, I am saying that it will reach at that level, and that is when we will have to reassess and think how is the deposit cost environment going, or if there is any further increase on the lending rate. But on a steady state basis, let me tell you, let's assume that the ticker stops here on the lending and the deposit rate side. We expect this to move to 7.75 to 8%, and with the change in mix happening, it will further come down over the next 1 to 2 years to 7.5%.
Got it. So, Sunil, actually, as in I was looking at it more from the perspective that, we expect slippages also to normalize from next quarter onwards. So, is there some amount of margin downside that we're building in for next quarter as well? Some softness because of the reversal still?
No, I don't think so. Clearly, we have to. There can't be a scenario of zero slippages, right? So there will be few slippages, as we discussed, in line with our guidance that we have given earlier, and we are building for that as well, right? So we will have to take it, because my cost of fund, the point I'm trying to make here is 70% of my book is a fixed rate loan. Right, and 30% is a variable rate loan. So the repricing of that 70% will come with a lag. And my cost of deposits have increased faster than the yield on advances. So that's the gap, and as that timing changes, this 7.75 can also improve.
Got it. Yeah, that part is understood, Sunil. Yeah. Just, one more follow-up, if I could, again, on the disbursement outlook. So the disbursement, if I just compare the number YOY in the microfinance book, it's down pretty sharply. So, and of course, there has been a change in how we are, giving out incremental disbursements, the change in the underwriting. So, any outlook in terms of the near-term growth in the microfinance book, considering, the YOY? Is this more of a steady state, or is this going to pick up substantially from there? Yeah.
No, there is always a seasonality on disbursement, so Q4 will always be better. And longer term, mid-term, we have already guided, right, that at a bank level, we are looking at 22% around plus advances growth, of which microfinance should be 17-18%.
Okay, we're sticking to that. Okay. Thanks, Sunil. Yeah.
Thank you.
Thank you. Our next question is from the line of Jai Mundhra from BNK Securities. Please go ahead.
Yeah, hi sir. Good evening. If you can provide a weightage average tenor of, let us say, group loans and individual MFI loans.
What is the tenure of that? The group loan is a majorly 1 year, and the individual loan is a 1.5 year to 2 years.
Sure. And secondly, on the stress pool, right? So if I were to look at SMA 0 plus 1 plus 2, last quarter to this quarter, the dip is around, if I were to calculate, is around 28 billion. And let's say 25-26 billion has been slippages out of this. So more or less, the understanding that there is virtually on a net basis, the forward flow has been more or less negligible. Is that the math, right?
Yes, that's what it looks like. That's how it is.
Right. Okay. And lastly, on deposits, right? So you had mentioned that part of this deposit QOQ decline is because of the bulk rate or the rate differential between TD and SA has reduced dramatically. But in the analyst meet, right, in the first week December, the bank had presented that SA should be growing by at least 15-16% YOY, and then it has actually quarter to date or maybe YOY it actually declined. So just wanted to double check: is this the only factor, or that has also changed something which is apart from just the rate differential?
No, it's a rate differential. See, we were a bank which was always offering a premium rate on SA, right? Unlike large banks who still work on a 3% SA rate. So it is very natural that we will have a rate sensitive, and it's an impact of that.
Right. Sure, sir. Yeah, that is all from my side. Thank you.
Thank you.
Thank you. Our next question is from the line of Kaitav Shah from Anand Rathi. Please go ahead.
Good evening. So thank you for taking my question. I just wanted to understand more about the housing finance book. You can talk more about the average ticket sizes, and if within the disbursement mix, if you can give us color more on the premium segment class that you were kind of alluding to earlier. What sort of proportion have you reached there?
Suresh, you want to take that?
Yes, sure, I'll take it. Thanks. Yeah, so in terms of the composition of the incremental business, we are seeing a good traction in the prime segment, as which is now contributing almost 16 to 17% of the incremental business. And in terms of the overall book composition, we still have majority of the book being the affordable segment only. Almost 18,800 crores is in the affordable housing segment only. So the majority continues to be there, but we are seeing a good traction in this segment of prime home loans.
Okay. And sir, some color around the average ticket size of the housing finance book over 2 years. How would it have moved? 2 years, 1 year, whatever.
Yeah, sure. So in the last 2 years, it has moved from about average ticket size of the incremental business being to around 11 lakhs. So now it has moved to close to 14 lakhs if I look at the overall full year. But on a month-on-month basis, it is kind of increasing. So 14 would be the average of the entire year, but probably incremental. If I look for the month of December, it's around 17 lakhs.
Okay, sure. Thank you so much. That's it. All the best. Bye.
Thank you, ladies and gentlemen. That was the last question. I now hand the floor back to the management for closing comments.
Thank you, ladies and gentlemen. Thank you for your time. Wish you a very happy new year again. Thank you.
Thank you to all.
Thank you very much.
This is the management. On behalf of Bandhan Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.